Welcome in, folks. Busy day here. Oh my gosh, we have a lot to get into in this one. First thing I want to get into is hot stocks. I own some stocks that are just making some historic runs right now. We're going to talk about that. Do I think these runs are going to continue? Do I think they're going to slow down? Am I planning on selling some of these stocks and taking profits? Am I planning on continuing to buy these stocks? So we'll speak about that in this video here today. Then I want to react to 4 videos in this one. First one up here, U.S. job creation totaled 254,000 in September, much better than expected. This is a reason the market's going very risk on here today. Fed's Gooseby on a superb jobs report, inflation rates. Looking forward to hearing from him. He's definitely very influential in regards to the Federal Reserve and kind of moves there. Tom Lee, we got to buy one, get one free in this one regarding Tom Lee here today. So Tom Lee, I've been wanting to react to this one. 2 days ago, he went on CNBC, spoke about a 6,000 S&P 500 year-end price target. Looking forward to reacting to that one. And then 44 minutes ago, Tom Lee went on CNBC, spoke about markets are in a tricky period due to geopolitical risk and October seasonality. So looking forward to reacting to that one here today. Okay, appreciate y'all joining me as always. Thank you for smashing that thumbs up button. Everybody that does it, I appreciate you. And also, additionally, thank you to everybody that has subscribed here to the channel. Nearly 51,000 subscribers strong, like Donkey Kong here on the channel. Appreciate each and every one of you. 1000xstocks.com. If you would like to apply for access to 1000xstocks.com, you can go to our sales page, 1000xstocks.com. Apply for access. That gets you obviously access to the advanced software, advanced to the basic education, the advanced education, all that good stuff. The projections feature, it's all in one package, baby. Conference calls, SEC filings. Oh, it's beautiful. So once again, if you want access to that, go to apply for access on 1000xstocks.com. All right, guys, so let's start going through this. I got some red hot stocks. SoFi, I actually wouldn't consider this red hot. It is up 9%, but given the environment we're in right now, I would expect the stock to be up even more. I would expect SoFi to actually be up 15 or 20% in the past month. Now, here's a deal in regards to SoFi. It's very important everybody understands this. This stock is going to $20 plus quickly if there can begin to be a lot more confidence in the actual underlying economy. If we get out of this fear of recession, if we can get out of that, this stock will make a run to 20 fast. The reason the stock is being held back is there's still so many worries about it. We're going to have a hard landing, a medium landing, those sorts of things. And so when people have all those concerns, you don't want to own a stock like SoFi, right? And so it kind of gets thrown out. It kind of gets treated like a lot of regional banks get treated, right? People say, I don't know about that one. If there could be more confidence that comes into the actual feelings around the economy, SoFi will be 20 before you know it. Now, Cheesecake. This is a run. So Cheesecake's up about 10%. Now, this is a restaurant stock. So 10% a month with no earnings, that's a historic run. This is insane. This is a restaurant, right? Now, I think there's 2 things going on here in regards to cake. One is we know we're going in a lower interest rate environment. That's phenomenal. Cheesecake Factory has a lot of restaurants to build between North Italia and Flower Child. They have a lot of restaurants to build over this next 5-10 years. So if we could be in a lower interest rate environment, that would be ideal for Cake. And I think that's definitely going to benefit them. And I think that's one of the reasons people are looking for the stock. I think the second small reason is it's got a big dividend yield. So I think people are starting to look for yield, and Cheesecake provides that, right? And the third reason is I think actually finally some people are starting to wake up to the fact that Cheesecake has 2 brands that are going to become national brands across the United States of America, right? North Italia and Flower Child. They have not one concept, but 2 concepts that you're going to see expand all across the United States of America. And they're the only ones that are in that position as a restaurant chain that has 2 concepts that are about to go national over the next 5-10 years and become huge brands that are going to be known in every major city out there, right? And so that's just an incredible opportunity. So I think some people are starting to wake up to that. And that's why you're starting to see more and more momentum come in that name. And as somebody that wants to hold this stock long term, this stock could be $200, $300 stock someday. I do not want to sell any shares of Cheesecake, right? Honest has been a cold as ice stock, but I wouldn't be surprised if it comes back to life. I still think this baby's getting out of the gulag this year. I really do. And out of the gulag's $5 plus. I really, truly believe the stock's getting out of the gulag this year. And so They got to come through with good earnings. They come through with good earnings. We're getting out of the gulag, baby. And we're never turning back in regards to that. So we'll see. Shopify. Shopify, very nice move here for Shopify. 13% plus in the past month. Here's the deal in regards to Shopify. It's one of those stocks you buy and you buy more and you hold and you hold and you hold. And you just call it a dang day. Okay, not that complicated. Celsius Holdings, cold as ice. We know that. Stock's down 17% in the past month. This is opposite of hot. I went very in depth in regards to Celsius last night on the channel. Did I buy Celsius stock today? The answer is yes. I bought Celsius stock literally today. I went very in depth on Celsius. I think I did like a 19-minute video on Celsius last night on the channel. So if you want to hear me talk very in depth about Celsius specifically, watch the video I produced on this channel, the reaction channel here last night, and you'll get to see that, okay? Tesla, Tesla, listen, those delivery numbers were a huge breath of fresh air for me specifically. Huge breath. I loved those numbers. Right? Were those the most exciting growth numbers in Tesla's history? No, absolutely not. But very nice numbers compared to the previous quarter. We're headed back in the right direction. Those numbers made me feel much more optimistic about Tesla. I can tell you that. That was a big. Very, very happy in regards to those numbers. So now 1010's up next. Winning resort stock is ridiculous. Ridiculous. In the past month, the stock is up 37+%. 37+%. It's insane. Insane. This is what's so beautiful about being a stock picker, is how irrational the stock market can be. Did Wynn's business model just fundamentally change for the positive or something like that in the past month to make it go up nearly 40% the past month? No. People were just irrational with the stock. The Vegas numbers are incredible. The Macau numbers continue to strengthen, and they're pretty dang incredible. The Boston properties numbers have been good. Like what? And we're going into a lower interest rate environment. So now all of a sudden everybody wants to own Wynn stock? Like, come on, man. Like, this stock is set up in such a phenomenal situation. Like, and people say, oh, well, it's the China stimulus measures. Listen, Macau's putting up great numbers, regardless of the China stimulus numbers. Like, okay, let's say it helps a little bit. Okay, big deal. Like, Wynn's customer base, they're rich no matter what, right? If somebody's going to go drop $100,000 on some baccarat at Wynn Palace, like, whether there's stimulus out there or not, like, it doesn't really matter to them. So my opinion is the market's completely been irrational around Wynn, and now all of a sudden they want to own Wynn. It's hilarious, man. It's hilarious. The market can be so irrational, but as a stock picker, we love that. It's a phenomenal opportunity for us, right? PayPal's made a move here about 10% in the past month. Obviously PayPal has a long run to go. This stock, I see a day when it's 120. I see a day when it's 150. I see a day when it's 200. So it's got a long run ahead. Chris, he keeps coming in with these numbers. Oh man, did I buy PayPal stock today? I think that's a fair question. Did I buy PayPal? The answer to that is yes, I bought PayPal stock today, right? And even though it's made a very nice move here recently, the stock's still heavily undervalued in my opinion. So I'm like, hey, it's $79. Give me more PayPal shares. Palantir. Oh my gosh. 33% move in the past month for Palantir, and it's over $40. Let's go, baby. Let's go. Very exciting. And here's the deal with Palantir. If Palantir, if the company comes through with a 30% plus revenue number and a 30% plus revenue guide, we're going 50. Now, if the company comes in with, let's say, revenue growth at 23%, 24, 25, something like that, I think there's a decent probability we go right back down to $32, $35. I think it really comes down to this. I think if we can go 30% plus revenue and people start getting confident about 30% plus revenue, psychologically, that's such a key number for Palantir that I think you'll see another huge upward move in regards to Palantir stock after their earnings. But like I said, if the numbers really disappoint, don't be surprised if it goes back down to 32 to 35 range. But what a run for Palantir. Fubo's been cold. I don't get it. I honestly don't get it. everything's improving in their business model dramatically, and not just like small amounts, like the legal stuff's going the right way. I mean, Fubo, I would say of the past several years, Fubo's probably the least risky at right now than it's been in years. And so the fact that that stock's less than $1.50 is mind-blowing to me. I would think this stock would easily, I wouldn't expect it to be out of the gulag, but I would expect it to easily be $2 or $3 right now. $2 to $3 range, yes. And then we can say, if all of a sudden the company gets to like a break-even quarter in the first half of 25, I think the stock gets out of the gulag. Once people are confident, like this company is going to stop being a money burner, I think we get out of the gulag. We go over 5. But for right now, given the losses coming down, given the legal stuff going in the right direction, more subscribers, more revenue, I would think $2-3 right now. Like, I'm mind blown. So I don't know, maybe this makes some historic run at the very end of this year. But and obviously, if we go into a lower interest rate environment, that's good for Fubo as well, just in case profitability takes longer than expected. But it doesn't look like it's going to. So I don't know, man. I don't know. Either I'm wrong on the stock or it's about to make a historic run. That's all I'm going to say. And you'll see the stock. And that is something to keep in mind with these stocks. When they do run, it's epic. It's epic, right? Honest is a perfect example of that. Honest is up 215% in the past year. And this run it made from from basically the beginning of November to let's call it the end of December. So this was around less than a 2-month run, right? The stock went from $1.10 to $3.40. So that's why I say, like, could Fubo go from $1.50 to $3+ by the end of the year and make that move in a matter of a month or two? I mean, it's possible, right? I'm not going to bank on that, but it's definitely. Would it be surprised if Fubo went from $1.50 to $3.50 by end of year? Wouldn't even surprise me one bit. So once again, I wouldn't bank on it, but I wouldn't be surprised. Elf on a Shelf is as cold as mold. The stock's down 23% in the past month, like dramatic, right? Here's the deal in regards to Elf. The same people that are rushing out of the stock to sell at $100 are going to be the same people running into the stock to buy it back at $200. It's ridiculous, man. I mean, such a great company, such a ridiculously great performer, and top notch. Like, this is one of probably the top 10 most well-run companies in the entire stock market. Like, put them up there with NVIDIA. Put them up there with whoever you want to put them up there with. Meta, right? Palantir. They're a historically great company. And, it'll come around. Amazon's starting to run a little bit, but the stock has floundered, in my opinion, up about 6.5% in the past month. I think this one still has a big run ahead. Zoom stock. So Zoom stock is, not in the best place. I mean, the stock's actually down in the past month. The thing with Zoom is interest income is likely going to decrease over the next, I would say, 1 to 2 years. They're still going to have a massive amount of interest income coming in the next 1 to 2 years, but it could go down. And so that could actually hurt Zoom's profitability a little bit if they can't offset it with actual gains in the business model, right? Revolve's looking good, about 11% move in the past month. This is one of those smaller cap companies that will continue to be in a very good place in a lower interest rate environment, right? And the consumer coming back and not being sliced and diced by inflation. Estee Lauder, I'm actually surprised this one hasn't made a bigger move in the past month. I am. It has made a big move from here, 82, where it ran up to 102. But 4% in the past month, I'd actually think the move would be bigger, just to be quite frank. Nike, starting to come back a little bit. This one's got a long road ahead. Meta stock, I mean, it's an animal. 15% in the past month. On a 1-year basis, 92%. On a year-to-date basis, 69%. Whichever way you want to slice it, it's been a historic run for Meta. It continues to be. I think the stock's on its way to 700. And then we'll figure our way to 1,000. And last up for my stocks here, Monster. Oh, actually not last up. Monster, kind of floundering a little bit. 3% move in the past month, which is fine with me because it's a very new position for me. The Planet hasn't done a dang thing. If we could see more broadening in small caps, and then Planet, I don't think people are ready for these Planet numbers over this next year. I don't think they're ready. Oh my gosh, people are going to have their socks knocked off there. Avant stock sucks. Just sucks, man. 15% plus move down in the past month. Business model's been looking pretty good, but people just don't care about this company. I think they got to get to solid quarter in, quarter out profitability. I think more people will care about Avant. And I think the move could be pretty historic in regards to Avant, but we got to see quarters in, quarters out, real profitability, gap profitability for this business model, and then we can get some real momentum in regards to that one. So yeah, man, it's a lot of nice big moves out there. Win looks like it kind of takes the cake in the past month here. 37% move, absolutely incredible. But yeah, great to see Palantir over 40, right? And just phenomenal. Alrighty, let's start reacting to these videos here.
As we come hitting the wires on the September jobs report, the over wins 254,000, significantly better than 150 expected, and an upward revision to last month from 142,000 to 159,000, which means the 2-month revision now is a little over 70,000. If we look at the unemployment rate, it is at 4.1. 4.1, it moved lower. I can hear yields moving higher as we speak. And 4.1, of course, equals where we were in June. You have to go to May to get a lower number at 4%. Average hourly earnings month over month, better than expected, up 0.4%, which equals where we have been in May. You have to go back to the beginning of the year, January, when we were up 0.5%. Now, if you look at average hourly earnings on a year-over-year basis, this number also much better than expected. 4%. That equals where we were in May. You have to go to March to find a higher number at 4.1. The work week, 34.2, which makes it actually a 10th less than expected and a 10th less than the rear view mirror. To find a lower work week, you have to go back a long way. You're going to have to go all the way back to...
So this is, let me just be as frank as I possibly can in regards to this situation. Listen, this is the best case scenario. The best case scenario. We have inflation that has come down massively, right? That's no longer an issue. And you have employment holding up. That gives a lot of people a good feeling about soft landing, no landing, those sorts of things. It doesn't get better than this. This is as good as it gets.
34.3, which is going to be in February of this year. And finally, the utilization, the labor force participation rate, 62.7. It's been holding there. Not a bad number. 62.7 is actually the best number of the year that we've seen on multiple occasions. You have to go to November last year to find a higher number at 62.8. And finally, the underemployment rate. The actual employment rate of 4.1 is called U3. U6 is the underemployment rate, and that has been moving higher. It was at 7.9 our last look, which was the highest since October of 21, and it came down 0.2 to 7.7, which would equate it to the lowest level since June of this year. So yields have shot up. We're at now 394, 395 in a 10-year. We see 385 in a 2-year. These are big, smart reversals. Today now marks the 3rd consecutive session that Treasury yields have climbed over the previous day's high yield, or if you want to look at it in terms of low prices, which means we're building momentum to higher yields. And that's important considering we settled the 10-year last week. Get this, at 375. So we've seen some significant moves. And on the short end, we settled a 2-year last week at 356. So it's up 30 basis points from last week.
Wow. Yeah, I don't know if the TLT crowd really likes this, just to be honest. I don't know if they really like this, the TLT crowd. Yeah. They don't like this. They don't like this action. A lot of the people have been thinking like TLT's easy money, right? Yeah, it certainly hasn't been easy money thus far. And the worst thing is, people are playing this TLT, right? And they're missing out on just ridiculous money to be made in the market. Like, could you imagine being heavy sideline cash or heavy TLT, and you're watching stocks go up 3, 4, 5% day by day by day? You're watching a Wynn Resorts go up 37% in the past month, right? And you're on the sideline for that? Even a Tesla, which hasn't even had the best month, but it's still up 14%. Could you imagine being on the sideline for that? Or in TLT? Could you imagine missing out on Palantir? Look at the 3-month in Palantir, 48%, the 1-month, 33.33%. And you're in TLT? Oh my gosh. But these people want to play these games in and out of the market, in and out of stocks, in TLT. Come on, man. Gooseby.
Thank you for being with us. And
Good morning to you.
You know where I got to go first. You're the one that said we need to cut significantly in the future in order to keep the unemployment rate from rising. Do you still feel that way after the unemployment rate fell and if it was rounded down by 0.02 of a percentage point, it would have been 4%?
Yeah, look, my statement was about over the next year and what's the long arc. This jobs number today and the whole report is a superb report. You really couldn't ask realistically for a better report for the economy, coupled with the finding out that the port strike is not going to be an extended matter, and that at least for months this is not going to be an issue.
Oh man, you can already tell they're popping bottles. Yeah, they're popping bottles at the Fed right now, right? You got inflation dead, and then on top of this, you have this good unemployment report. Oh man, they're going to be celebrating into year end now at this point in time because I mean it's just like everything they want to play out is playing out. So they're good for this year, right? I think we have question marks in the back half of next year. That's the main thing, right? Because we could see a reinflation of, kind of a re-engagement of inflation, certainly in the back half of the year. If we really start having commodities run, let's take a peek at GSG. Yeah, GSG back to 22 plus. I'm telling you, that we could have inflation problems, believe it or not, again in the back half of next year. And so they're going to be popping bottles into year end. But I'm just telling you guys, we could have some shakiness next year, some big shakiness next year, maybe in the summertime.
Those are two pieces of very good news for the economy. I still think as a central bank, you don't want to react too much to 1 month's report, but the revisions of the previous month's upward in jobs growth and the unemployment rate coming down. If we get more reports like this, I'm going to feel a lot more confident that we are, in fact, settling in at full employment.
I know this has only been out now for a little more than an hour. Has your staff or you looked into it enough to try to figure out why the report was so good?
Well, I mean, you're getting a lot of the estimates of GDP growth still continuing to suggest that growth remains robust. So I think the first thing about job growth is that it's tied to how the economy is doing. So if you get strong reports, that's likely to be correlated with strong GDP growth. As I say, we've got some cross currents, and we need to take the longer arc. We had previous to this one 2 disappointing numbers. Now we have a superb number, and we need to keep monitoring it. If we get more reports like this, as I say, I think we should have more confidence that we are, in fact, settling in at the landing spot that we want from a dual mandate perspective. Inflation has been coming in right around 2%. If the unemployment rate is going to settle down as something just over 4%, you would love to freeze frame that and put the picture on the wall.
Does this perhaps change the emphasis a little bit?
Now, the important thing in regards to, the important thing to remember in regards to the Fed and in these moves is the Fed lags, right? There's lags here. So they're making this move now that's going to be felt a year from now, 2 years from now, 3 years from now, right? It's not like it's really felt today. And so if you look back at any kind of historical cycles, like usually there's a 1 to 3 year lag there. So the Fed lowering rates now will probably be felt at the end of 2025 or in 2026, 2027. So you can't just look at now and say, well, the unemployment rate's really low right now, so you don't need to lower rates. It doesn't work like that. You need to look at it from kind of the perspective of, kind of where's the puck going? As Wayne Gretzky would say, skate to where the puck's going, not to where the puck is. And that's how you got to think about this. Sure, the unemployment rate's very low right now. We're in the fours. It looks great, right? But you got to understand, 9 months from now, 18 months from now, 27 months from now could be a whole different ballgame. And that's why you have to put rates in the right place for that future. Otherwise, you end up in a screwed up situation like we end up with inflation, where the Fed kept interest rates too low for too long, right? And then we had this massive upward movement of inflation that was very dramatic. So the Fed, you can't call, in my opinion, soft landing, no landing, hard landing, anything like that right now. We're going to call that in 2025. 2025, we're going to find out, did we have, and when I say 2020, I'm really talking about the second half of 2025, right? When we come upon the lapping of 1 year since we started lowering rates. That's when we'll be able to, I think, call the game and figure out, yeah, you know what, we landed it, it was great, or, oh boy, like the Fed should have lowered much more aggressively. Well, that's when we'll find that out. Fundstrat's Tom Lee on S&P 500, 6,000.
Just for his latest musings on the markets, it's managing partner, head of research at Fundstrat Global Advisors, as well as a CNBC contributor. People forget, I think, but your outlook and views are always nuanced to some extent, Tom. So last time you were on, after being pretty bullish on small caps through the end of the year, I wouldn't say you didn't change that long-term view, but you did express some near-term caution. And these people want to know, the people that follow you, the people that watch Squawk Box, they want to know exactly what to do every minute of every day. So it looked to them like you had waffled on your long-term view. And you're going to say the same thing today. I think near-term, you acknowledge that there could be some bumpiness, choppiness, but by the end of the year, you think 6,000 on the S&P.
That's right. I think we're still in the midst of a very tricky period because we've got the election in less than 35 days. And now we've got two things that investors don't know how to discount. One is, mounting tensions in the Middle East, and then a port strike that is potentially going to cripple the economy. And so I think that as investors worry about this, if we get a dip, and a big dip, I think you still want to buy that dip because the setup into year end has a lot of tailwinds.
The worst case scenario for the port situation is something that we've seen. And we shut down an economy already, and that was probably a time to buy. We know that. So we've seen that movie before. Could it be, I can't imagine it could be as bad as the pandemic, but we have shut down an economy before.
Yeah, that's right. So I think it creates headline risk because, the longer this strike lasts, there'll be companies that miss. And so S&P earnings might get downgraded or some stocks might miss results. But that's all just temporary. I mean, those are just short-term headwinds because it doesn't change the long-term outlook.
It's very strange that I don't remember any war that lasts, that where the effects, and we've been through quite a few back in the 90s and in the 2000s. It never seemed to have as negative an effect on the overall markets as we thought at the beginning of each.
That's right. In fact, if we look at the last 6 sort of global wars or tensions, you almost always buy the invasion. The exception was 2022 with the Russia-Ukraine war because we were also in the midst of a Fed tightening cycle. So that was not a buy the invasion event. But the other times you did want to buy.
Both Iraq wars.
Yep, both Iraq and...
Yeah, 100%. I mean, usually if you're really thinking about when's the market going to be a big problem, it's one of two scenarios. One, the Fed's raising rates rapidly. Look at 2022 for that example. One is where the Federal Reserve is lowering rates rapidly. Look at 2008 for that example, right? Usually if you're in either one of those environments, you're usually in some trouble in regards to the market because that means the Fed's freaking out. And they're either freaking out because the economy is really bad or they're freaking out because inflation's out of hand, right? Those are the two real times you get an actual major market kind of hit, right? S&P 500, 20% plus, Nasdaq, 30% plus, in either one of those sorts of scenarios.
Was the market, where was the market before that happened? Had levels come down, or were they trading at near highs or at highs?
Yes, this is different because we are hovering near highs and we're in an extended market.
And things aren't cheap in terms of multiples.
That's right. But at the same time, we also know there is a lot of cash on the sidelines because margin debt hasn't risen for 4 months. I mean, that's pretty unusual with a rising stock market. And now money market cash has actually been rising at a time when the Fed is cutting. So I do think there's firepower.
The other issue, just the longshoreman strike, if that goes on for an extended period of time, is that something?
Well, that's already, we're already moving on from that, right? So markets are in a tricky period due to geopolitical risk and October seasonality from an hour ago.
Now our next guest points to October as a seasonally iffy part of the year, expecting investors to buy whatever dip emerges this month because the positive tailwinds into year-end, he says, are stronger than the headwinds. Joining us today is Tom Lee, Fundstrat Global Advisors Managing Partner, a CNBC contributor. Hey, Tom, good to see you.
Hey, Carl, how are you?
I'm good. What do we make of the market in light of the jobs number and a VIX, which I know you're watching, but is still close to 20 today?
Yes. I mean, I think we're in a tricky period because there are these sort of complications, which is geopolitical risk. We've got the port strike out of the way, and I know October has these seasonals. I think it's very good news to see the stock market react positively to a jobs report because it is, in fact, a good report showing the economy is actually not only holding up, but the unemployment rate's down. But I agree with you. The VIX is important to tell us how much we could rally. I know our head of technical strategy, Mark Newton, thinks that we're making intraday lows today, and it's setting up for us to make new highs next week. I mean, to me, that makes sense just because it has been a resilient economy, and then next week we get CPI. But I do think it's hard to say this is a green light into year end because, as you're pointing out, the VIX is just staying stubbornly high.
Tom, we've seen some changes in the swaps
market. We have seen periods, it's important everybody understands, we have seen periods in the past where VIX goes high and actually the market moves up. So it is something to kind of keep in mind. I've seen it before several times in the market where VIX is relatively elevated and the market's moving up and moving up and moving up.
With regard to expectations for future rate cuts, at least in terms of magnitude, how does that alter the calculus, if at all, for the equity markets? If it is now looking more like a 25 basis point cut in November instead of 50 basis points in those weightings changing, does that impact expectations in the equity market, or that's not really priced in at this point in time?
Well, we know that Fed fund futures and expectations about the magnitude of cuts over the next couple of meetings does affect the bond market. And we're seeing that reaction today. And, of course, I'm even seeing some folks think the Fed made a mistake with 50. But for the stock market, I think what matters more is really the Fed. The Fed is actually in an easing cycle, and we're making our way towards neutral. And so I think that there is going to be times where the stock market, where the S&P is going to rise even if yields are up. I think we're in an instant there because yields can be rising because the economic data is better, and so we're kind of rising for good reasons on yields, and I think that's supportive of stock. So I'm not too bothered if the odds of a 50 have dropped today because of a good jobs report, because I don't think it means the Fed is suddenly backpedaling and back to hiking mode.
On China, Tom, is it good for global growth? But how is it offset, if at all, by any kind of drains to liquidity or just the rush of hot money to either cover shorts over there or try to play along with this?
I think on balance, it's very good news that China's PBOC and the government have launched a bazooka series of measures because it has been, on a relative basis, a drag not only on the global economy, but a huge underperformer for the past 10 years. I don't think U.S. investors are selling their U.S. equities or even small cap stocks to buy China. I think it's coming out of all this cash on the sidelines. We know margin debt hasn't moved for 4 months, and it's still way below the 2021 highs of $936 billion. And we know there's $6 trillion cash on the sidelines. So I think this is motivating money into action, but it's overall, I think, a positive.
Alrighty, guys, appreciate you joining me as always. Thanks so much for being here. 1000xstocks.com. If you're looking to apply for access, you can go to our sales page, 1000xstocks.com, and go ahead and check that out. Much love and have a great day.